Okay, good morning, everyone. Today is the final day of the semester, so it's great news. And what we're going to do today is I'm just going to go over some problems and exercises from Chapter 17. Obviously, as I've said before, that we've adjusted some of the due dates for homework, quiz, and bonus in particular. Not so much the exams, because I really think those are important to sort of keep on schedule, but the homework, quiz, and bonus for this week have been moved to the 8th. It's the very last day of the term, so if you're unable to get it done by 11:59 p.m., I think you're going to get kicked. I think you may have 5 minutes, 6 minutes of grace period, something like that. So, and there's really no opportunity to do any kind of makeup. I'm literally going to be reporting final grades for this section on Monday morning, probably around 9 o'clock. So, whatever happens, I do not wait till the last minute to do these. The final exam itself, which is, and I'll talk about this before we leave today, I'll go over a bit of a review. Obviously, some of this is a little bit outdated, not proctored. Of course, it's not proctored, it's online. But it's going to be comprehensive, and it's going to be due on the 6th. That's Friday. So make sure that you get that done by Friday. I've built in a couple of extra days of potential leeway, just because I know that sometimes things do happen. The stakes are a lot higher for the final exam, frankly, than they are for any of the homework, quiz, or bonus activities. So if for some reason you do get kicked out, or you have a power outage or whatever, you can get with me. I'm available all weekend. I usually don't go anywhere, or I'm not terribly engaged anywhere else the last weekend of the semester. So get with me if something does happen. There may be a chance I could reopen that for you over the weekend. But after the 8th, which is Sunday, there's really no opportunity at all. And that is sort of the end of the line. So, okay. All right. I don't think we have anybody on the Zoom call just yet. So if you're watching this as a video recording, that's fine. One thing I'll point out, and I know I mentioned this at various times, and partly this is on me because I didn't get, I didn't sort of realize that I was not including an attendance link, but there's an attendance link that I post every week for anybody who does not watch does not either come to class or watch the live Zoom feed. And not a lot of people have been posting to those links. Really, it's to your advantage to do so, but obviously it's a little bit late in the day to keep reminding people, but it is there, and it is something that you should take a look at and to post your attendance to. The only reason I do it, it's not some formality, it's really a requirement of the Department of Education that we do that. So, okay. All right, so 2 things on the agenda. I'm going to go through some example problems and exercises today. And I'm going to go to the back of the text here. And I want to do, and some of these are fairly brief, and that's sort of by design. I don't want to, I'm going to be sort of going back and forth, bringing the screen up, taking the screen down, and whatnot. And it's just kind of the way we have to more or less operate here. One thing I do want to point out, and I want to come back to this in the PowerPoint presentation that's available for you in Brightspace. I think it's around the 30th slide. This really is, I think, just ultra critical because it lays out for you all the formulas that allow us to determine price variance, which is a dollar variance, or the volume or quantity variance in this direction. Just imagine there are minus signs, this minus this, this minus this. Together, the aggregate price and quantity variance will result in a total variance in either direct materials or direct labor. This does not apply to overhead because overhead we talked about before as being a predetermined rate based upon some driver. Often labor hours is the driver. And I think all the examples that are used, I haven't looked at every problem in the back of the chapter, but I think most of the examples in this chapter are dealing with the drivers being labor hours. And that's common, particularly in a service sector. That's not unusual at all, but knowing, of course, there may be other drivers like machine hours or machine setups or moves or inventory orders, whatever the case might be. But in this case, you can base upon that. So price variance, this minus this, quantity variance, this minus this. And by the way, some of the examples I'm going to be using will calculate one value, and we don't do it again because within the same problem, it's already been calculated. So let's take a look at this. Let's do the first one here. What I would say is I would print this off or have it available, whatever, have it handy. I think it's a great cheat sheet. That, as well as the actual Word document that was, I think it was back in the incremental analysis I could find it here, but I think it's particularly useful. It's a formulas sheet that looks something like this. And I forget exactly where that was, but it's not hidden at all. It's in Brightspace. And we talked about this earlier on with regards to using it, particularly related to things like cost volume profit, break even, contribution margin ratio. That's another, another valuable resource that I think you should be looking at. Okay. All right. So let's do this. Let's take a look at the first problem that we're going to do. And unfortunately, just because of the technology we have to work with here, I'm going to be sort of bringing this up and then taking it back down again. It's just kind of the way it is. And so I want to do practice multiple choice from the end of chapter 17. In this case, let's do number 7 first. A producing product, AA, 6,300 pounds of direct materials we used at a cost of $1.10 per pound. The standard, okay, and again, the standards are those things which are sort of set ahead of time that represent the word should. That is, we should only use this much at this dollar figure, this quantity, this dollar figure. Standard was 6,000 pounds at $1 per pound. The direct materials quantity variance is what? Okay, so we're doing one variance, and it's materials variance, and it's going to be the quantity variance. So what do you do? Let's just kind of flip back here what we're doing. Quantity variance is simply, and all you're really doing here, the math should not be the enemy here at all, because I think it's pretty much all laid out for you. Actual quantity times standard price minus standard quantity times standard price. And then what are the differences? If this is greater than this, then that's unfavorable variance because the actual is greater than the standard. If this is less than this, it's a favorable variance, just in terms of the quantity variance. And that's the only calculation that we're going to be doing for this particular problem. So why don't we do that? Let's take a look. And again, I'm going to sort of take the screen up here a little bit just because the camera only goes one way. And so we'll go through this one. So, all right, this is practice multiple choice 7 on page 17-28. And let me see here. I've got a black marker. I think that sort of shows it best. All right, so practice multiple choice 7. So we're only doing one fairly straightforward calculation, page 1728. So what is the formula here? It's basically actual quantity times the standard price, net quantity minus the standard quantity times the standard price. Okay, and all this information is given in this particular case. We're saying that the actual quantity is 6,300 units produced for whatever the time period was, and what was the standard price? Was it $1? Was that the standard price?
$1.10.
Was it $1?
Sorry.
No, it's $1. That's $1.
Yeah. Actually, it's
$1. So it's $1 minus the standard quantity, which we're saying was 6,000 times the same dollar. The standard price is the same, which is why those are the same as well. And really, if more you work with these problems, I think the more you can sort of look at it and say, aha, I know what this is going to be. And that this is a quantity variance, and so you did a lot more than what than what was sort of anticipated here. But the problem is, though, that the actual quantity is going to be what? So it's going to be 6,300 minus 6,000. Okay, so the variance here is going to be a $300 variance. Okay, $300 variance. And we go back to this particular problem here in the text, and I've picked some of these just simply because of the fact that we've got the idea that the answers are there, and it's an unfavorable variance. And it's unfair. I know this is hard to see. I realize that, and I'll take this down. But it's unfavorable because more material is used than what was prescribed by the standard. So this is then the standard was 6,000 units of input. These are inputs, right, to produce the same outputs. So we're using more inputs than what we thought we were going to. So we're going to say it's unfavorable. So the answer to that was 300. Unfavorable is the quantity variance for this particular problem. Okay, and that's essentially what's going on with that one. That's not too challenging, I think. Really, it's it is one of the more straightforward ones. But we're going to do some examples of other problems that get into both materials and or labor variance from a price variance as well as a quantity variance, and then together the two of those net themselves out to be a total variance altogether, okay? So, all right, let me kind of zoom in here a little bit so we get a little bit tighter view of the screen and whatnot. So let's do the next one here, which is right down below it. Practice multiple choice 8. It's a different scenario altogether. And in producing product CZ, 7,400 direct labor hours. So now we're talking about labor, not materials, right? We use at a rate of 1640 per hour. The standard, however, was 7,500 hours at $16 per hour. And so based on these data, the direct labor what? So you've got a different number of different choices. Is it a quantity variance? It's whatever the answer turns out to be. And we're going to have to sort of work through the numbers to find it. But what we have to do, though, is to do both variances, quantity and price variance, both in order to answer this question. So why don't we do that? Let's take a look. This is practice multiple choice. And I think these are, at least in my opinion, these are probably pretty representative of what you might see on the homework quiz type scenarios, particularly in the homework, which gets into a lot of these. And so this is practice multiple choice 8, and we want to do a couple things. We want to do the price variance first. So again, I'll refer you back to the that PowerPoint slide, which I think is really ultimately important, and you probably ought to save some out. And the formula is basically this: it's actual quantity times the actual price, and it's going to be minus the actual quantity times the standard price. That's how we get to the price variance. Whether it's labor or materials, in this case, it just happens to be labor as the input, as that we're trying to absorb into product cost. And again, why are we doing all this? We're doing it because we're trying to assess how well we're on target, first of all, how well our budgeting is going, but also, are we meeting the standards that have been set? Now, no one is saying the standards are always realistic. I think there are plenty of examples in which management overshoots the expectation, but fortunately, reality will set in, and so sometimes they have to adjust their expectations. And so let's plug the numbers in here and see what we get. We had 7,400 units, that is hours worked, in other words, times $16.40. That was the actual wage incurred, which is usually kind of the average wage. That's usually the way to look at it. The standard was 7,400. I'm sorry, the actual was 7,400 again, against a standard price of 16. So simply do the math here. All you do is plug it in the calculator. We get 121,360 minus 118,400. We get a variance here of 2,960. And is this favorable or unfavorable? Well, because the actual is greater than standard, it's unfavorable. So we have this as an unfavorable variance for the price variance. Now, this is not the final answer because we also have to do the quantity variance and then take and then find out what it is that we're being asked to do. And I think this is one of the tricks to doing some of the problems in this chapter and maybe everywhere in accounting courses is to find out what it is they're asking. And so they're not even asking for the total variance, they're asking for whatever is listed in the multiple choice scenario. So we do price variance, let's do quantity variance here. The quantity variance formula is actual quantity times standard price minus standard quantity times standard price, okay? And the standards are set ahead of time. And in this case, we have actual quantity times standard price, which is already calculated. It's 118.4, which is why I say sometimes we've already done the math here. 118.4 minus the quantity of standard quantity of 7,500 times the $16 wage. That is the standard wage. And so we get 118.4 minus the product of this 7,500 times 16, which is 120,000. In this case, we get a variance that is going to be 1,600. These are dollars, these are all dollar figures. And what is it? Is it favorable or unfavorable? Well, if the actual is less than standard, then we would consider that to be a favorable variance. So that's the only way that we can answer this question, is to determine what it is that we're being asked to do. So, all right, so we got two variances. We computed price variance. Excuse me, we computed price variance. We also computed quantity variance. And so what is it that we know here? All right, so let's answer the question. And sometimes doing too much is a bad thing. Just simply answering a question is really what's the answer. So Of these, which is the correct answer? This is practice multiple choice 8. This is right here. Quantity variance, price variance. And the answer here is the quantity variance is $1,600 favorable. And so that's A. And that is the answer to that one. That's right. None of the other ones make sense. And so this is a question in which all you're simply doing is, excuse me, answering the question that's posed by the authors here. What are we asking for? Okay. And it's a pretty limited example. But in order to do it, because some of the answers include quantity variance and price variance, you've got to do both calculations. But again, hang your hat on that, print that slide off, do whatever you want, save it somehow. Unless you can, and I've got a mnemonic device that I always used everywhere in managerial and cost accounting, and I don't know that I recommend it. I've given it to classes before, they just kind of look at like, I don't know, it's not for me. So whatever works for you. And believe me, mnemonic devices are going to be your friend, and they're going to be helpful throughout. So how it works, but the easiest thing of all, rather than creating some new system out of whole cloth because you're limited on time, is to simply use that formula, which I think is really good, and really sort of lays out in a graphic kind of way what's going on. The only thing missing are the negative, are the minus signs, because you're taking the difference between those blocks as you go. Okay. All right. Let's skip down a little bit here, and I want to go to some of these ones that are not that don't involve calculations really at all. Let's do number 12. This is number 12. In using variance reports to evaluate cost control, management normally looks into what? All variances, favorable variances only, unfavorable variances only, or both favorable and unfavorable variances that exceed a predetermined quantitative measurement, such as the percentage of dollar amount. Well, the answer to that is going to be D. And let's talk about why, because this is an important element of what's known as management by exception, and that is the idea that not every variance is something that requires management involvement. Sometimes variances are going to happen, and sometimes the variances, as I think I mentioned on Monday, are going to be large and significant, but as long as we can explain them and justify that, it might make sense. Remember, all this material sort of ties into each other. When we talked about incremental analysis, maybe we have a special order. Now, it's really going to cost us a heck of a lot to do, but we're going to get an incremental revenue that's going to way exceed the incremental revenue or the incremental cost. And so maybe we're well above standard cost, standard price, but it makes sense to do because the ultimate goal is not to meet budget, but to maximize profit, right? It's not the goal to necessarily make budget, it's to maximize profit. So in this case, it's both favorable and unfavorable. So it's not just favorable, it's not just unfavorable, it's both favorable, then exceed a predetermined measure. And this has to do with whatever the policy is. Usually companies will establish some sort of internal policy by which they say, okay, any variance over this particular percentage or dollar amount, whatever we're talking about, is something we look into. And this is really what management is there to do, is to find out what's going on. Remember, if we go back to one of the early things we talked about in this class, planning, organizing, and controlling are those main efforts of managing a business. And one way to control things is to monitor them and find out what's going on. And today, with technology, a lot of managers are able to get lots of information in not exactly real time necessarily, but pretty darn close. Certainly not waiting until the end of a quarter when we report to the rest of the world. This is internal reporting that can be done very, very quickly, even by day, even by shift if necessary. Okay? All right, let's do the next one, which is going to be number 14. Okay, and some of these I think you've got in your book, some don't. Which of the following would not be an objective used in the customer perspective of the balanced scorecard approach? Okay, so I like this question because it brings us back to this idea of the balanced scorecard. And we talked a bit about it on Monday, and we talked about what it was and what kind of approach. And it's not been around forever, but it's kind of gained acceptance in some areas. And it's subject, as I mentioned, to lots of adaptation and flexibility. And in bigger organizations, particularly when there's an assessment of senior managers, a lot of times industrial psychologists will be involved in determining this, because how do you hold people accountable for things they can't control? And they may not be able to control the share price. I mean, that's, if you hold every manager accountable for the share price, that's not really on them, or even the entire earnings of the company. So there are things that they can control, and so there are things like the percentage of customers who would recommend the product to a friend. Customer retention. Retention is a big subject. It's been a big subject for a long time. You know, the research has been pretty unequivocal that it costs more to find a new customer than to keep an existing customer. So customers who have complaints, usually if they're a pretty good customer, they'll get their issues dealt with because they don't want to lose them. The seller doesn't want to lose them. Brand recognition, earnings per share. Well, the only one of these that we consider a financial measure is earnings per share, because remember, when we talked about the customer orientation, which is just one of a number of different things. Some of it has to do with quality. Remember, we're talking about categories within the balanced scorecard. Some of it has to do with quality of product or labor training, labor retention, right? None of these are really financial measures. They're measurable and they should be measurable, but they're not financial measures. And so in this particular case, the only one that does not make sense is earnings per share. And it's not really in the customer's perspective. So remember, we have different areas of assessment in the balanced scorecard. Some of it has to do with customer relations, like retention and satisfaction and surveys and all that. And I noticed that, and I noted Monday the difficulty with surveys. But things like labor, management and effectiveness, efficiency, waste, all these kind of things. Even things like the absenteeism and safety. All of these are areas that really don't translate to external reporting. So, and so, in other words, the balanced scorecard is used to assess management's effectiveness in doing a lot of different things. Okay. So, any questions about that one before we move on here? Okay. Let's take a look here. I want to go to the practice brief exercises, and I've just got a few to go over here. And some of these, I've got one. This is a fairly brief one, and then I've got one that's fairly lengthy, and then I want to sort of, I'm having an eye on the clock here because I do want to talk a bit about the exam, so I want to make sure I have some time. I don't want to go too far over. I know that as I was preparing for class, I thought that maybe I was going to go a little later. If I do, obviously you've got the right to turn off the video whenever you like. So, all right, let's do practice brief exercise number 1. Okay, this is on page 1729 in the e-text, and let's take a look at what this is. The Castellan Company accumulates the following data concerning raw materials in making 1 quart of finished product. Whatever it is, we don't know. The price is the purchase price of $3. And we got some discount terms, 210 net 30, which is sort of red herring. I don't know if we really care about the discount terms, but we will care about the fact that there is a discount, right? I mean, we don't care about the net amount is due. Freight in is 25 cents per unit. Remember, freight in is often an inventoriable cost. If the buyer, in this case us, we're Castellan Company, if we pay it, it becomes an inventoriable cost. Not freight out so much, which is considered more of a period cost. And receiving and handling, 10 cents per unit. Okay, so those are price issues that would go into the price calculation. And under quantity, we have required materials 2.7 pounds, and allowance for waste and spoilage of 0.3 of 1 pound. And so we're being asked to compute the standard direct materials price per quart, standard direct materials quantity per quart, standards, right? And then the total standard materials cost per quart. Okay, the output. So the output unit is 1 quart of whatever this is that they're producing. Okay. All right, so let's do this. This is kind of taking us in a bit of a different direction, and we're sort of approaching this maybe a little bit backwards, but hopefully it will make sense once we start to lay out what's being asked for here. So I'm going to go ahead and erase some of this, and let's do this. This is practice brief exercise 1. I think, is that what it was? Practice brief exercise 1. And it's on page 1729. And okay, so this is not a particularly lengthy one. So let's do part A first. And we have a purchase price, okay, of $3. And so it's $3 plus we've got a discount. Okay. Now, when I say we don't care about the discount terms, we do care about the fact that there's going to be a 2% discount, right? So a discount simply is this. It's going to be the purchase price times that discount amount, right? Which is 2%. And then that's itself is going to equal it's going to be 6 cents, right? So it's going to bring our cost down to $2.94. Everybody see what I did with the discounts? A 2% discount that they're taking, 3% times, I'm sorry, $3 times 2%, 2% discount is 6 cents. And so it brings the net price down to $2.94. Okay. Net of the cash discount, right? When we say 210 net 30, it would be net of any other discount. If we did not take the cash discount, we are taking the cash discount. Plus, we're adding in some freight costs. And we're saying it's 25 cents per unit for freight. That's freight in, sometimes called transportation in, and 10 cents per item per unit for handling. Or I guess receiving is what they call it, yeah. Receiving, handling, it's, whatever you want to call it. It's pretty much the same thing. So we end up with a unit price here, which is, we're going to say is going to be a standard price of $3.29 per unit, okay? Now, we don't know what this output sells for. We don't really care here. This is all we're being asked to do is compute the unit cost, the standard unit cost in this case, okay? And where do we come up with these numbers? Well, we think this is what it should be costing us. And we can assess performance in terms of things like price and quantity based upon these standards that we're setting ahead of time. But that's essentially what we're looking at here, okay? In the case of Part B, we're saying that there's some spoilage that's built in here. And so in Part B, really what we're talking about is a quantity standard where it's 2.7 pounds of whatever it is, right? Plus 0.3 of a pound for what we call slack or wastage or spillage, evaporation, whatever it is. And so you're going to end up with a standard here of 3 pounds per unit. These are input units, okay? And that's what's going on there. So then the final answer here, which sort of closes the loop on both standard price and standard quantity, is what is the final standard here in terms of what should it be costing us? And the actual question itself, you see how they worded it here. It's in Part C, it's total standard materials cost per quart, okay? So again, it's a dollar figure multiplied by a number. So you're going to get the standard price, $3.29, times the standard quantity, which is 3. So the math is really not that challenging. And you're going to get $9.87 as the standard cost per unit. This is the standard that we ought to be shooting for, and any variances that go throughout the accounting period that differ from this, either positive or negative, are going to be assessed against this, assuming that this is a rational figure in the first place. And again, when we talk about flexible budgeting, sometimes the standards themselves can change, and I'm an advocate for changing budgets when the facts change. But nonetheless, you're going to have some sort of standard in order to measure performance, and this is one way to do it. One way to do it is to simply establish standards so that management knows what they're trying to shoot for, and that they can identify variances fairly quickly. Okay? All right, so any questions about that one? I think we've got a couple people on the Zoom call here, but let me go ahead. I'm going to erase this because I got one that's fairly lengthy, and it does sort of, I think, tie into a lot of different areas as to what's going on here, because we'll do a quantity variance, price variance, and so there are a lot of different elements of this, and it's going to be one of the lengthier ones I'm going to be doing, but it's one that I think really realistically is going to be representative of ones that you're going to see if you have not yet done the homework quiz scenarios yet for this chapter. All right, so let's do one more, and then we'll talk about the exam and what to expect on that. So let's bring this up here. This is going to be practice exercise 1, and it's going to be on page 17-30. And it's going to ask for really a lot of different things going on. It's going to ask for labor and materials variances. So you're going to have the total, which is going to be the aggregation of price and quantity. They're going to be added together. Sometimes one may be positive, some may be negative. So you're going to end up, that's going to be based upon the variances for materials and for labor both. And you're given these facts here. So the Hector Incorporated produces a single product, which kind of makes our life easier. There's only one output. Has prepared the following standard cost sheet for one unit. You say, so these are the standards, okay? Direct material, $6, £6, 6 pounds, $2.50 per pound, right? It's a quantity standard and price standard. Direct labor, 3.1 hours, $12 per hour. Quantity standard, price standard. And then we have, and during the month of April, we have the actual. These are the standards, these are the actual. We had direct materials purchased was 1,600 pounds at $4,192. Direct labor, 760 hours at $8,740. And so in this case, again, and the outputs are 250 units for this one particular month, and we're trying to assess management performance in terms of adherence to standards and whatnot. And we're going to do the total variance, which is essentially price and quantity variances for materials and labor. All right. So let's do it. This is a problem that asks a lot of things, and so let's do it. But I really think, I really believe that if you know the direction you're going, it's not. It looks worse than what it is, and I think you can say this about anything that involves some mathematical calculation. I really believe that. If you have a roadmap and you know which direction you're going, once you do it, you think, wow, look at what I just did. But it's not all that challenging. But just knowing what you're doing in the first place is the first step. So let's take direct materials first. Okay, so we're going to be asked to compute variances, both price, quantity, and total for both materials and labor. So there's quite a lot going on here. So let's take a look at, in this case, we're going to do the price variance on materials. This is materials price variance. And so, and again, the calculations are the same in terms of what we're using, but we're talking about different things. We're plugging in different values, and so as a result, the numbers are going to be different. But what is this? It's actual quantity times actual price minus actual quantity times standard price. You go to that little cheat sheet there, slide 30, you'll get all this. And this is just materials. And so the actual quantity used in the month of April, 1,600. And it was going to be at a, let me see here what I've done. It was going to be an actual price of $2.62. And where did that number come from? Basically, it was the idea of we had a total cost incurred was $41.92 over the 1,600 units. So we ended up with a value of $2.62. Okay, we had to do a little bit of calculation. I don't want to make this overly messy here, but that's how we got to the actual price. This is actual price. Because remember, we took the actual data given in the problem itself. Minus what? Well, so it's actual quantity, which again is 1,600 times the standard price, which was $2.50. So immediately we know we've got a variance here. It's not going to be a good one because we've got a variance that's the actual exceeds the standards, and all we do is look at here and see that we've got the actual price is a little bit higher. So as a result, we end up with what? Simply do the math. 1,600 times 262 is 4,192 minus 1,600 times 250, which is 4,000. So the difference here is 192, and it's unfavorable, as I think I sort of alluded to a minute ago. You know, but everything else is the same except for this, and that's the actual price. So we have a variance, and it's considered an unfavorable variance on materials. Okay. And if you want to know how to get this, this is actual price, which we have to do a little bit of a calculation of. Okay. On the quantity variance. All right. So let's take a look at quantity variance here. What do we have? So we've got the formula for quantity variance is actual quantity times standard price minus standard quantity times standard price. Okay, always. In this case, we've got some of this has already been worked out for us, and so in this case, what we have actual quantity times standard price is 4,000. We already computed that, so that's done. That part is done, right? Minus the standard quantity times the standard price. And in this case, it's going to be, we're going to again do the math here, where we had 250 times 6 is going to give us 1,500, and that's going to be the standard quantity. That's based upon the level that we're looking to do here, right? So as a result, what we have here, we have 1,500 times the standard quantity times standard price, which was 250, that was given. To do the math here, we get 4,000 minus whatever this is, which is going to be 3,750, and we're going to have another variance that's going to be 250, and it's going to be considered unfavorable because the only thing that differs here, the standard price is the same. The only thing that differs is the actual quantity. Okay, and the actual quantity is going to give us a variance here of 250 negative. So as a result, total materials variance, right? So this is one part of it. Total materials variance is going to be the sum of these two. So they're both negative, right? They're going to be both negative. So we're going to have, you might as well look at this. If you put them unfavorable, so 192 and 250, right? They're both negative. So you're going to have 442, which is the same thing as a negative total variance that's unfavorable, just in terms of materials. And the only reason I bring negatives into the picture here is because they really are negative from what our expectations are. Remember what negative variances do, they add to the cost of goods sold, which reduces gross profit, which falls all the way to the bottom line, okay? So that's essentially what's going on there, okay? All right, so that's the price, that's the direct materials. And the second piece of this is direct labor. I realize this is a bit of an involved problem, but it's one that we should be talking about here. And so we get to price variance. And so this is labor, that's materials, we're done with materials. Let's take a look at labor now. And price variance is going to be always really the same form, actual quantity times actual price minus actual quantity times the standard price. Okay, always, okay. And we're given the actual quantities here at 760, which was labor hours, and we want to compute here the actual price of labor, which we're given as having incurred 8,740, and over that 760 hours. This is the actual over the actual wages and the labor hours, and so we are going to end up with a figure for actual price of $11.50 an hour, which is going to be good if you're trying to control wage costs because the standard was going to be $12. That's out here, right? So in other words, actual quantity was the same 760 times 12. So all I'm saying is that you can just sort of eyeball this and say, all right, well, the only thing that's different here in this entire form is this here, the actual price. And the actual price is just based upon the wage costs incurred. Why is it lower? I don't know. Maybe it's we were more efficient. Some of our part-time workers worked fewer hours. Maybe they were more efficient and they got their work done quicker, whatever. We don't really know. But we think, okay, well, we know it's going to be favorable. So if you do the math, 760 times 1150, it's going to be 9,120. These are dollars. All these are dollars. 760 times 12 is going to be 9,300. The actual is less than the standard. So as a result, we have a variance of 380, which is considered to be favorable. That's the price variance for labor. Labor price variance is favorable. And if management really wants to know why, well, we can dig into it and find out. And that's something that may or may not be an objective, but it's something they can certainly look into if they want to find out. If it's a favorable variance, and by the way, sometimes favorable variances, you want to know why it's favorable because maybe you want to replicate it somewhere else in the organization. That's entirely possible. Or maybe you want to even check to make sure the numbers are right. And because sometimes you get really good numbers and you start to think, do an end zone dance and spike the football. Then it turns out the numbers are bogus. Not because necessarily someone is trying to pull a fast one, but maybe just the numbers are wrong. So this is what management exists to do, is to sort of drill down into it to find out what's going on. Okay. All right. So we did price variance on labor. Let's do quantity variance on labor. The formula is once again the same: actual quantity times standard price minus standard quantity times standard price. The more you do these problems, which I encourage people to do, the practice problems, the better you get at doing them. So in this case, we're talking about labor, the actual quantity, and actual quantity times standard price was actually given. Well, we computed it. Let's see here, actual. Well, let me just do the math here. I'll just work it out. So 760. We said $12 was the standard price. Standard quantity times standard price is going to be basically this. We know the standard price is going to be 12. But what about standard? What about standard quantity? In this case, we said it's going to be it's going to come out to 775, which is going to be the actual incurred, which is 250 times $3.10. So we're going to end up with a figure here of 775. Okay, this is based upon the standard information that was given early on. That was standard quantity here. I'm sorry, standard price that was given. I'm sorry, I'm looking in the wrong place here. Standard price and standard quantity. So if you do the math, you get 760 times 12, which is going to be 9,120 minus 9,300. These are all dollar figures, and so in this result, we have actual less than standard. And the way these are sort of laid out is the actual is going to be usually, if you're following the same format, actual is going to be the left, standard is going to be the right, and you're going to end up with a favorable variance, so it's going to be 180 favorable, and that's a favorable quantity variance. So to sort of wrap this up here, we've got what is the total labor variance? And it's going to be basically the variance in price and the variance in quantity. So we have 380, it's a positive. Obviously, we don't always put positives there, plus 180. And so we're going to get a total variance of 560 positive or a $560 favorable variance. That is the total variance on labor. So even though we have an unfavorable variance on quantity, I'm sorry, on materials, we have a favorable variance on labor. These dollar figures may or may not be impressive or compelling to management, but they nonetheless are what they are. And again, whether management decides to act on them in one way or the other is simply up to management and to determine what it is that they want to do with it. Okay. All right. So that kind of does it for what I'm trying to do there. I did want to, if you have any questions individually, get with me individually on these if you would, because I do want, I've got about 30 minutes and I don't want to take too much time and go over my allotted time here. In fact, I think the Zoom call will probably come to an abrupt end at some point. So I do want to talk about the final and give you some hints and some tips and some updates and some ideas as to what you're looking at. So again, you want to do this before Friday, so you've got some time. If you haven't already done the exam, it's available. It's been available since Friday, so you can do it. It's going to be 35 multiple choice questions, and you've got 90 minutes to do it, and you've really got one attempt. So kind of make it a good one. What I always tell people to do is sort of, get a comfortable place, get everything set up, get a cup of coffee, whatever, however you take your shoes off, whatever you want to do to get comfortable, and just settle in to do it in one sitting. I don't think right space does not do well with people going in and out of things. And I know sometimes people always don't have that idea in mind. They kind of go in and out, or something happens, they take a phone call, or somebody bugs them, and try to get in a place where you're not interrupted, and it's just the way to do it. So it's pretty good.
You said how long it is?
It's 90 minutes. 90 minutes, yeah. So you have 90 minutes to do the exam. So there are 35 questions, and it's considered to be comprehensive, meaning it goes back to the very first of the class, back to chapter 10. Chapter 10, we talked about things like ratio analysis and all that. And so let me give you a bit of a view as to what things you might want to be looking at and focusing on for the exam itself. Some of these are going to be based upon common sizing. Remember what common sizing was? When we simply take, in the case of the balance sheet, everything is as a percentage, every line item is as a percentage of total assets. With regard to the income statement, every line item is as a percentage of net sales. And so all you're doing, if it's asking for something like, fixed assets as a percentage of total assets, just take fixed assets, net of accumulated depreciation, divided by total assets, okay? Or if it's something, and it's not going to be one of the problems, but or if it's current assets divided by total assets, it's going to be a percentage And that's all it really is. All common sizing allows analysts to do is to take firms of different sizes and be able to compare their financial standing. And that's all. I mean, you could take one gigantic firm versus one very small firm and use ratio analysis in the form of common sizing in order to arrive at some kind of conclusions. And some of these are sort of universal. If you've got lots and lots of debt in relation to assets, well, you've got a lot of debt in relation to assets. And so you can say you're a highly leveraged company with a lot of debt. So if you have very little, regardless of how big you are, it's going to be a different picture altogether. And remember that we talked about, so common sizing is just one technique that we use, particularly what we call vertical analysis. So vertical analysis is this idea of taking everything on the same financial statement. And the only ones that we really got to were the balance sheet and the income statement. Now, obviously in managerial accounting, we don't deal a lot with balance sheets and income statements because those are externally prepared in accordance with GAAP. But again, this was a carryover from 2110. In the vertical analysis, we use that common sizing technique. Unlike horizontal analysis, which goes across over time, we have more of a time series analysis where we can say what's going on over time with the company and what has been the change in sales, the percentage terms, change in cost of goods sold, whatever the case might be. And so as a result, you've got to kind of look at it that direction. So horizontal and vertical analysis are a little bit different in that regard. Okay. And there's a question about why we use ratio analysis in the first place. I sort of alluded to it a second ago, and it's the idea that we can compare things for firms of different sizes. We can do peer analysis. If you have one small competitor going up against a big Goliath in the industry, the ratios take away the size differences and allow us to determine financial performance. And sometimes just looking at financial statements don't really allow us to sort of tear into them and find out what's going on. And I think sometimes people who are not used to looking at financial statements will look at them and maybe focus on one thing, maybe sales, maybe net income, whatever, but you've really got to tear into them. And that's what financial analysis is all about, is really digging into financial statements and to find out what is going on, okay? All right, also, if you, any kind of percentage change in anything is always going to be this. It's always going to be the new value minus the old value over the old value. It's going to give you some percentage change. Always, always, always. And when I say new minus old, you could say it's new minus original, whatever you want to call it. And whether it's a dollar figure, numbers, whatever it is, you're going to get some percentage. But just kind of remember that. And I bring this up because I can't tell you the number of times when I was in the business world where sometimes people would take the difference between two values, maybe from one year to the next, changing sales, right? And do I divide by the new number or by the old number? It's like the old number. You got to refer back to where you came from. That's the whole point, is referring back to the historical information. So you can determine what the percentage change is since the original number was recorded. That's what's going on. Sometimes that is not always a fact. That's remembered. I think we talked a bit about that in chapter 10. Okay. All right. There's also, in moving to chapter 11, we talked about the idea of what managerial accounting is. We said it's for internal use only, and it oftentimes results in very detailed reports that are not really for external consumption. They're just not. And a lot of companies are very jealous about this information. It's oftentimes considered strategic, and even in cases, I think I told the class that even when I was a lower level manager, some of the reports we would get would have values that would be masked out. We weren't authorized to have that information. So, but it produces very detailed reports, and it's also customizable. You can customize them and produce reports on whatever time schedule management prefers. Monthly reports are very common for a lot of different areas. You could drill down into weekly reports, daily reports, per shift, whatever, per product, per region. I mean, all of these are sliced and diced and organized based upon whatever management's needs are. And it's the term managerial refers to the fact that it's useful for managers to make decisions. Okay. All right. We also talked about the three categories of cost, which by now we've sort of beaten that dead horse: direct materials, direct labor, and manufacturing overhead. just kind of know what those are. Know too that manufacturing overhead, if we take a look at these three categories, again, direct materials, direct labor, manufacturing overhead, we know that these two together are considered to be what we call direct costs. And the costs drop directly on, and they're easily traceable to inventory costs, product costs. Manufacturing overheads are considered indirect costs. And when we talk about indirect costs, we're talking about things like what? Indirect labor, indirect materials, and those costs which don't really easily apply to any single product, especially in any individual unit of product, because they're spread out over maybe a lot of other different products. Things like depreciation on the building in which we make 10 different products, or the supervisor, the plant manager, who is responsible for making those 10 different products. And that, or if it's in the case of indirect materials, they're just too minuscule to attach the product. And some of that is subject to wastage, even things like packaging and adhesives and glues and paints and screws and all kinds of finish. I mean, all these things are part of indirect materials that don't easily attach themselves to individual products. Okay, so kind of know what those three categories are and what goes into them. And labor, I think, is not really particularly difficult at all. It's basically, particularly direct labor. I mean, you just simply compute direct labor, hours worked times the wages, which is usually already collated for you because firms have forever been really good, usually at accounting for wages. And it's not just wages, it's also benefits, remember. And it's also things that the firm incurs, things like payroll taxes, the firm's portion of Social Security and Medicare, as well as unemployment taxes. Those all go into direct labor. But those aren't particularly complicated to compute. Indirect labor, a little bit more difficult. Direct materials are those things which directly are reflected in the product itself. If it's I don't know if it's a bicycle, I think we use the bicycle example, then the metal used in making the frame of the bicycle will be a direct material. No question about it. Okay. So kind of, take a look. Some of this is obvious, but make sure that you're aware of what is categorized and how it's categorized. Okay. Also, we talked about the different kinds of accounts for inventory that you did not see in Principles 1. I think we may have alluded to it a little bit in Principles 1, but we didn't really get into, in that course, work in process. And work in process is an important inventory account. It's basically all these direct materials, direct labor, and whatever we're absorbing in overhead, and the work's not done yet. We've got an unfinished product that's moving its way through the production process. In some cases, these work in process inventory is not very big. It's very quick to produce a product, but some products are not easily produced. 747s take a long time to be produced, and so we've got a large work in process account. Anything involving construction is a work in process type inventory account. So kind of know what goes into it, but then also know that there's a intermediate account that's usually not reported on income statements to external users. It's called cost of goods manufactured. Okay, and kind of know what's going on with that. Simply taking beginning work in process plus all these product costs, direct materials, direct labor, manufacturing overhead, minus ending work in process gives you cost of goods manufactured. And that is not anything different than the whole idea of how we account for inventory in general. Beginning plus new goods, but these are not purchases, these are work in process, right? Minus ending, and that gives you a cost of goods manufactured, which is very analogous to cost of goods sold, except it's not cost of goods sold because they haven't been sold yet. This is an intermediate step. Until the goods are sold, it's still part of inventory. Cost of goods manufactured, though, allows us to determine what is the cost of those goods not yet sold, and when they're sold, remember, we then and only then record cost of goods sold. Everything else is what we call capitalized, and it goes into inventory based upon whatever it is. But they all go into the WIP account. Okay. All right. Any questions so far about anything? All right. In chapter 12, we talked about something called job order costing, and probably I don't know that every introductory managerial accounting course talks about job order costing, but We like it because number one, it's got a great applicability across different industries, not just manufacturing, which is often the sort of the default setting for really all of our accounting courses, but also it applies to services. It can include financial services and whatnot, but it's based upon the idea that we're costing jobs based upon whatever the characteristics are of the particular job in question. So if you're making a motion picture, for instance, that would be a good example of job order costing, where everything that's being done applies to that particular job. But making one movie over here is not the same as making one movie over there. And we want to keep these straight, right? We may allocate overhead to different areas, and we've talked a bit about overhead, but the key thing is to try to attach cost to the jobs. Why? Because we want to find out what it costs us to do a particular thing. So in the case of construction, which is one example I often use, if you're a builder who's building 50 houses, you want to make sure you've got the labor and the materials that go to each house, as separate jobs, so you can know what it is it costs you to do that job. And maybe if you're not making money on every particular job, maybe you want to ask yourself why, and does pricing need to be adjusted somehow? And if pricing needs to be adjusted, can you do that? And it could be that you decide, I don't want to do this anymore. I want to do something different. I don't want to build low-end houses. I want to build high-end houses, or vice versa, right? Whatever the case might be. So you attach, and I'm talking about labor that goes to all the work that goes into making that house, which is different than all the labor that goes into making this house, all the way across. So, and you can have multiple jobs being done. That's really what's happening with job order costing. Okay, and there are a couple questions that we'll ask you to do a little bit of math, and I wouldn't stress over that so much. Basically, just kind of, take the numbers as given and follow the logic of what's happening in terms of direct materials, direct labor, and all of that, okay? So that's essentially what is going on. Let me see what else. Oh, when we talk about, this is, I think, where we first started getting into this idea of overhead and assigning overhead to work in process or cost of goods, whatever you want to call it. And that was the idea of where do we come up with overhead in the first place? And it's a little bit cart before the horse, because we sort of mentioned, okay, the budgeting process will be determinative as to what we decide total overhead is going to be for the organization. And then we'll assign it based upon some rational means to individual products, units, divisions, whatever. But the key thing is there's going to be some predetermined overhead rate, whatever that is. Maybe it's $3 per labor hour based upon some driver, right? So every labor hour, we're going to assign overhead to that particular bit of inventory that's being produced, or whatever the figure is, right? And it doesn't have to be necessarily based upon labor hours, it's based on something, but it's predetermined overhead rate, and we're going to sort of stick with that. And a lot of times companies do a very good job of estimating what overhead is going to be, because remember, it flows out of the budgeting process, which we didn't get to until a little bit later, but we sort of alluded to it and said that firms usually get pretty good over time at determining what the overhead is going to be. A lot of it is influenced by historical costs, but it's not just historical cost. It's also it's that plus an expectation of what is to come. Okay. All right. There's also a question about the changing nature of inputs, and just to kind of give you a bit of a hint as to where it's going. One of the things that we've been seeing is an increased use of automation, particularly in manufacturing. Less reliance on labor, human labor, obviously, and more reliance upon machines, which means that sometimes, in the case of manufacturing, maybe labor hours as a driver that we want to hang our hat on in order to attach overhead may not be the most appropriate. Maybe it's machine hours, or based upon runtime, we can measure how much time is being incurred by machines. So it's just that change. We talked about that. And remember, if we have inputs, and a lot of these machines are considered to be fixed inputs. So fixed inputs create fixed costs. And a lot of labor, particularly in the manufacturing context, is variable labor. And so variable inputs create variable costs. And so as a result, we're increasing the use of machines that is fixed inputs with less reliance upon variable inputs, that's labor. Not all industries are like that, certainly, but certainly manufacturing, The automotive industry has been forever, ever now, moving more toward robots, which do things like paint cars, weld things onto cars, you know, all that kind of thing, okay? All right, also when we got in chapter 13, we talked about cost behavior, and that was, we got in this idea of saying, okay, not all costs behave the same way. Variable costs are those costs which vary with the volume of production, up and down in the same direction, where fixed costs do not change, at least in the short run, right? In the short run, for our purposes, let's just say a year, a budget period, which I think a year is a sensible breakdown. Fixed costs just don't change. We're talking about things like salaries of workers, whether they're involved in production or not. And these are not necessarily product costs; they can be period costs. And variable costs are those costs which go up and down. If we're producing more units of output, we're going to incur more electricity as far as overhead goes, variable overhead, more materials used, those are variable costs. But things like the rent on a building, unless you build a new building, the rent on the building is probably going to be the same, right? The property taxes probably aren't going to change. So it depends upon the responsiveness to the change in the business activity as to whether or not it's going to be fixed and variable, okay? And the variable costs are going to go generally in proportion to whatever the change in output levels are, okay? And there's going to be a question in which you'll be given some cost data, and you want to sort of be able to tease out, just based upon the logic of it, what's fixed and what's variable. And that's pretty much all I can tell you, but you know, if you understand that some cost structures are going to always involve some fixed cost, I can't think of really too many production entities that are not going to have some fixed cost element. Once you understand that those exist, everything else is variable at that point, okay? So you want to kind of be aware of that. Also, we talked about something called the high-low method, and I think the example that we were given in the text was that of a construction company, I believe, right? And the construction company was, oh no, it wasn't good. It was transportation. That's what it was. It was like a bus company or whatever. And the bus company was doing things like they're using miles driven as a activity measure, and we had total cost measure. High-low basically takes high, both directions, right? High activity, which is associated with high cost, low activity and low cost. Given whatever information is given, 6 months, 12 months, I think we have two different scenarios given. And simply take the difference between those. You're going to get the variable cost. And once you get the variable cost, you can pull out the fixed cost. And I just refer you back to, this is chapter 13, where we did the high-low method. We also talked about an alternative method, which is not going to be covered in the exam. It was called the regression method. That calls for a little bit more math than what we are requiring here. But just know the high-low method, it's high quantity, high price, divided by low quantity, low price, and you're going to get an ability to measure that. So just kind of look in your text for that if you're unclear as to how to. I think there's only one question dealing with the high-low method. Okay. All right. I'm kind of running out of time. If I go over a little bit, I apologize. Hopefully, the Zoom call won't cut me off. There's a question in chapter 13. We also got to do the issue of contribution margin and what that was. So contribution margin is basically sales minus what? Minus variable costs. And we take out variable costs because those vary with the level of sales. And so, contribution margin refers to what? It's contributing toward the covering of fixed costs and total profit. And then know how to compute a contribution margin ratio. If contribution margin is sales minus variable cost, contribution margin ratio, just going back to our cheat sheet, is contribution margin is a dollar figure divided by the sales price, which is a dollar figure. It's going to give you a percentage, and it basically tells what percentage of sales is available to cover fixed costs and to contribute to profit. There's going to be a question dealing with that, and if you have that handy dandy cheat sheet, I think that will benefit you really immensely. Okay. We also had a question. There's a couple questions about break even, and there is a hack for break even. It takes total fixed costs over contribution margin ratio, and it's going to give you a break even in sales dollars. And I'm just looking at the sheet here, and so it's just a little hack, it's just a little cheat sheet that should help you. And remember, break even is simply that point at which can be measured in sales, dollars, or units that tell us there's zero profit at that point. And why do you care? Because you want to obviously get beyond break even to maximize profit. And then from there, you can assess how far you are from break even. In other words, if we lower the price, hence we lower our contribution margin, how closely do we cut it before we're breaking even? And it just gives you this idea of what we call margin of safety. Okay. In Appendix F, we talked a bit about this idea of overhead and what to do about it. And we said, and there was a 4-step process. You might look in your text for that. And early on, what you're trying to do is to define what activities are relevant in terms of producing whatever it is that we're doing, right? We're making movies, if we're making razor blades, whatever. What is it we're doing? What are the steps involved? And we assign some cost pool. And then the pool itself is one thing. We have to have some driver. And the driver the cost driver is something that allows us to absorb overhead as we go. So if it's labor hours, every labor hour we assign 20 cents to the unit of output as part of the overhead that we attach to it. Again, based upon if you go back and take a look at the total overhead that's budgeted, and we drop them into pools, but then the pools themselves have to have some sort of driver, and that's really what's going on there. So you can kind of take a look at that and go from there. And then knowing too that often there's not just one driver and not one pool. There may be several. And I think we have an example of a couple of different pools and whatnot. And there's a question dealing with what kind of driver would be acceptable for what kind of activity. So if it's a law firm, right? I think labor hours is almost certainly what you would use as a driver to attach overhead to individual jobs. I think that's almost certain. Labor, law firm, accounting firm, engineering firm, where there's lots and lots of labor involved and not very much capital goods. Yeah, there are computers, but we don't deal with computers 24/7, so it's not like they're running all the time. And so it might make sense to use labor hours in that particular scenario. So it'll just be whatever makes sense. Now, by the way, there's a question about why we would use activity-based costing, and one reason why is because, and I think I showed a graphic in the class, is that overhead costs are really, really rising dramatically in a lot of organizations, and we got to have some way of assigning those to product costs so that we can know what the profitability per all the products are going to be. And I apologize for going a little bit quickly here, but my time is short. But when overhead costs are extreme in relation to total costs, particularly direct costs, then I think it really necessitates some sort of use of activity costing. Okay, in chapter 14, we got into this idea of incremental analysis, where we said, we had a lot of different scenarios, but the bottom line was, if we do one thing and don't do it, we either do something or we don't do it. And it's usually some sort of new decision. Do we add a new product line? Do we discontinue a product line? We're taking incremental revenue versus incremental cost. If incremental revenue exceeds incremental costs, maybe we should do it, right? Or maybe find that which is the most profitable. But keep in mind the idea of what we consider relevant costs. Relevant costs are those costs which typically are variable in nature. That is, fixed costs we can't do much about. We're not going to sell a building because we decide to turn down an opportunity for a special order, right? So those are fixed; those are not relevant. We're going to incur them regardless of what decision is made. But the variable costs that are incurred, those are relevant. And whether it's the additional labor, maybe it's the overtime, maybe it's the new materials, whatever, those are relevant, as opposed to not relevant costs. And fixed costs typically are not relevant in that relation. Over a long-term time periods, yes, we can change fixed cost input mixes, but not necessarily in the short run. Also know too about sunk costs and what sunk costs are. Sunk costs are, and we talked a bit about this, these are costs which generally have already been incurred, and we're not going to recover the value of them because they're done. We ran an advertising campaign that didn't work. There's nobody to go to try to recover that. It's done, and we just kind of have to deal with it, right? So remember, incremental analysis deals with this idea do we do one thing? Do we do another thing? And it's not always one thing versus another. There may be 3 or 4 different alternatives that we choose to do. Okay, and so know what are relevant and what are not relevant in this particular example. And there are a couple of different examples in the text or in the exam about the specific scenarios that lend themselves to incremental analysis, whether it's buy or make, or whether it's finish processing or stop processing. If it's a good that's got different uses and we have a split off point, and I think the example was that of taking just raw milk, we're refining it into cream, we keep on going, it becomes cheese. All kinds of different examples of where we can stop making something, and or we can sell it and be done with it, going from there. Okay, make or buy is another one, and that's another particular example you want to kind of be familiar with. Repair a machine, repair or replace. That's another example. There's a question on the exam about repair or replace. What's it going to cost us to repair something, or what's it going to cost us to replace it? And keeping in mind that there may be revenue implications. The new machine that we buy maybe generates more revenue or reduces costs. So there could be incremental points of reference based on what it is we're trying to do. Okay. Chapter 15, Guide to Budgeting. We talked about what a master budget was. Master budget is really sort of a collation and a collection of all those budgets which go into that. And keep in mind, one thing that we said many times was everything flows from the sales budget. Sales budget begins, and if the sales budget is off by a significant degree, every other budget subsidiary to that is also going to be off. So the master budget really begins with the sales budget, and everything goes down from there. The materials budget, labor budget, overhead budget, everything else. Those are the operating budgets, but also even the financial budgets where we're trying to deal with things like cash. Well, if the sales budget's wrong, the cash budget's probably going to be wrong. So everything kind of flows from there. Notice too that when we talked about cash budgeting, a lot of companies have a policy where they have some minimum cash. They have to have it all times. It's a very firm policy many companies have. Even if they have to go borrow money to make that minimum, they will do that. And this idea of a minimum cash budget is very, very common. And a lot of companies will have all kinds of mechanisms available by which they end up every day with X dollars at minimum. If they have more than that, that's not so much an issue, I guess, but they may have to borrow, and if they have to borrow, that's fine. Then finally, we talked about standard costs and what standard, and that's chapter 17, standard costing. Know what standard costs are. They're simply a means by which we can measure performance. Direct materials, what goes in direct materials, and the fact that we account for some spoilage. I think I've erased that problem, but the fact that there's going to be some wastage or spoilage going on. And then I think there's one question dealing with a variance problem, very similar to what I did in class today. But a lot of what I did in class was to help you with the homework quiz and bonus. But there is one question, I think it's price variance, that you'll see on the exam. Okay? All right, so I went over just a little bit, I think, and I apologize for that. And but if anybody has any questions, feel free to get with me. I'm available all week and all through the weekend. So all you need to do is send me an email and let me know how to get in touch with you, and I'll do that. And I've enjoyed having everybody in the class. I haven't been able to see everybody since most people don't attend. But I'm glad you were able to take this course, and let me know if I can help you. Good luck on the final.